And there it is. The markets are officially closed. Welcome, investors and traders. I'm AJ Monte, and this is the weekly market report for this Friday, July 12th. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF. And if you had a chance to watch my midweek report, you'll have seen me draw this horizontal line up here as a short-term target, stating that there was a good chance we would see that target hit before the end of the week. So we did hit that. And what do we have there? We have a long shadow on top of that candle. And while the volume is still high, you can see down below that the CCI is starting to hinge. Now, if you follow my trading checklist, and I'll get to that in a moment, you'll know that between the hinging in the CCI, with it being in an overbought condition, the wide divergence from this moving average, and on top of that, seeing that long shadow on top, that is a shooting star. And shooting stars show up right when the markets are starting to pivot to the downside. You can see a small shooting star there. You can see a shooting star right there. This is very close to a shooting star, and you can see in all three of these instances the market drops. So I do believe that we will pull back in the Dow next week. And so now that that target is hit, I'm going to draw a downside target. Now, I'm not going to get too aggressive here. I have a couple of downside targets already established. This is going to be the short-term target. And I'm dropping it right there at 395.69 because as long as the price is staying over that moving average, the moving average will be drawn up to the price. You see, so my target here is mainly coinciding with where I think the moving average is going to be over Monday, Tuesday, Wednesday, perhaps. So that's my target on DIA. If we look at IWM, we have a similar story. We blew through this target that I had midweek at 204.53. So now that that target is blown through, I can get rid of that one. But look what we have here. We have a gap up yesterday as we went into a sector rotation, and another gap today. Now, the big difference here versus what we saw in the diamonds is that this too is a shooting star, and we saw a shooting star back here as well, but this particular shooting star is on lower volume, and that has caused the CCI not to hinge, but to completely pivot lower. So the CCI is extremely overbought. The stochastic is overbought, but it hasn't hinged yet. And therefore, I think we're going lower on IWM. Now, what I'm doing is I'm basically eyeballing where I think the Fibonacci retracement is going to be. So I think we could pull back right to that point, which would also match very closely to this role reversal support. Now watch, I'll do this as a backup so you can see how I'm eyeballing this, but if you want to use the Fibonacci tool, you take that low pivot down here, that low connected to the high, and you can see how close my target is here, this role reversal is, to the 50% retracement. You see that? So with practice and time, you'll be able to do this by eyeballing it, and you won't really need these tools. You just know from looking at the chart how far away it is from that moving average. So my downside target on IWM is 208.58. Moving on to the Qs, and I'm going to talk more about this as we get to the end. We have it's very close to a shooting star, but we have a bullish harami as well. Now, this could be very confusing because we have a bullish candle today and we had a very bearish candle yesterday with that bearish engulfing. Now, because the stochastic crossed today to the downside, I am looking at my trading checklist and I'm basically putting the check marks where I see buy signals and sell signals. So while the bullish harami is technically bullish, the shooting star with the long shadow on top is bearish, and the bearish candle from yesterday is bearish. The drop in volume on the way up is bearish. The cross with the stochastic is bearish, and we have a sell signal on the CCI, which is bearish, and we also have a gap down below the market that is going to act as a price magnet. So you could see how useful that trading checklist is, especially after you memorize it. and counting the signals and weighing the evidence buy versus sell. So I initially thought we'd get a little bit of a bounce, and we might see that on Monday, but I don't think we're going to rally into new highs. So for the short term, I'm going to be going down, and I think we are going to start to move down below that 20-period moving average. I know I'm stretching my neck out there, but I'm putting that downside target of 484.69 based on all these other indicators. Now, looking at SPY, you could see that we have a very similar candle. We had the bearish engulfing yesterday, bullish harami, but that shooting star. I said we would get close to this 566 level. We did get close to it with pennies, really, but look at that volume drop down there. See, that chalks up as a bearish candle. And so we're very close to a sell signal on the stochastic when the blue line, which is the %K, crosses the red line, which is the %D. That's the sell signal. And we're very close to a sell signal here on the CCI, and I think that will pivot lower. So I'm going right back down to this moving average, and then we'll check back to see what the charts are telling us midweek on Wednesday when I put the midweek report out. So my downside target on SPY is 550.07. Looking at the VIX, very interesting again, because we have the opposite of a shooting star is a hammer candle. I've been showing this over time. This is a hammer, perfect hammer here. This is very close to a hammer. That shadow need to be a little bit longer to be textbook, or the body need to be a little bit shorter to be textbook. But I'm treating that as a long shadow underneath the candle, which is more bullish than bearish. Now remember, the VIX, for the most part, is inversely related to the S&P. So if I'm bullish on the VIX, which I am, then that's going to support my downside target and what I'm seeing on the S&P. So I'm going right back up. I'm just going to reestablish this target from back here, and that target is 1362. So what I'm going to do is just change the properties on that to be 1362, and then we could move along and track that one. So that's my upside target for the VIX. And I want to just talk a little bit about our trades that we put out. And I normally don't do this, but we've got a big push going on right now for the free 15-day or 2-week trial. It's absolutely free on Sticky Trades. We do not take credit cards, and as a result of that, there's no reason for you to have to cancel anything. You know that game that most companies play where they get your credit card and then if you don't call them, they start billing you? We don't do that. And so we want people to see how accurate these charts are with forecasting. We want you to see the trades that we put out. And the only way to do that is to sample and get in there with the membership. On June 26th, our members bought Home Depot calls, and I was talking about this in Generac, which I'll get to in a minute, and I call these the hurricane stocks, and we got into this on June 26th. You have to understand, that was back here when we bought calls, and you could see, obviously, I have my price target here, and I have a gap fill target up here. So our option traders did tremendously well right now. And a shout out to those members. If you haven't taken a profit already, keep your eye on that drop in volume and keep your eye on these oscillators as they pivot, right? Hint, hint, protect those profits. The other one that we had was Generac, and that went out on July 3rd. That's GNRC is the ticker symbol. And look at this tremendous trade. This was one of the best trades of the year. And anyone who's gotten into our membership over the past couple of weeks and kicked the tires here at Sticky Trades, you already paid for a year's worth of membership right there. But on July 3rd, we put this trade out when the stock was pivoting up, and it just took off. Now, again, it's getting a little tired on the upside. I'm just giving this out to those who are members and to those who are trying the trial membership. This is how we trade. I use the trading checklist to get in. I analyze the charts using the trading checklist to protect profits and get out. And that was GNRC. Another one that went out on the same day as GNRC was Cameo Corp, CCJ. And our equity traders got in on this one. And look at that. boom, it just went straight up. Now, this is very close to a bearish engulfing. We're right at this target, within a penny of this target yesterday. Oscillators are going down. You see how we would protect those profits after we have a good trade on? You don't just hang on, get greedy, and hope that it's going to get better. The charts are telling you to get out, telling you to take the profits, and that's the way it works. Now, on the downside, our members on July 10th got into Tesla puts. Now, again, this was July 10th right here, right on that spinning top. Now, I'm just reviewing this for all of you, especially if you are trading it. Obviously, you want to know how the charts are working. But if you just watch this one as a spectator, let me just show you. The trade went out because I had my trading checklist. We had this long stale green light. We had that doji on lower volume right there, with the oscillators corresponding with a sell signal down here, wide divergence from the moving average, gap below the market. Boom, we buy the puts. Here was another home run. And today, with our option members, I put out, I think it was 4 trade notifications for our members to be taking in credits. We took in a boatload of credits today, and then next week, as we roll our spread positions, we're going to be making some more money there as well. I want to do a quick analysis of Bitcoin /BTC. I get this one quite a bit. You can see that my target on the upside is still around 66,000. It's kind of stuck in limbo right here between support and resistance. I'm still maintaining that upside target no matter what Peter Schiff says. He's a Bitcoin hater. I'm not going to go against Peter Schiff because I agree on a lot of his long-term views, but I think he may have it wrong on Bitcoin. I think eventually it's going to turn out to be the digital currency that drives our nation. Eventually. I know that's a long forecast out there, but I think that could happen. Now, speaking of the economic news, I just want to make sure that you understand, again, that we are using this trading checklist. All of our members have it. You have access to it through the trial membership and all that good stuff. And while 95% of our positions are making money on the long side, I am still putting the warning flag out because I do believe that we're going to see a catastrophe in the markets where the crash will be shocking. Now, I get a lot of questions about this, and people say, well, how come you're so bearish all the time? Because I have to be. When I show you all of these signals that I'm looking at week after week and month after month, yes, I'm still playing the market from the long side, and we're making money with that. But these signals are telling me, be ready to turn on a dime and get out of the water, so to speak. Right? If I was a lifeguard on the beach, I would be warning you and putting the warning flag out if I saw riptides and your life was in danger. Well, obviously, this isn't the beach. This is a marketplace for investors, but I am putting the warning signs out, and these are the warning signs. Again, the U.S. banks still have over $500 billion in unrealized losses due to the hit that they're taking in the bond holdings and the rising interest rates. Now, yesterday, the CPI numbers came out, and the economists and all the Wall Street Journal folks and analysts are celebrating, oh, the inflation is down. No, it's not, folks. It's not down. It's still up. It might look like it's slowing down, but I believe that they're just giving the Fed enough room or a big enough excuse to talk more about lowering rates. I do not think that's going to happen in September. If they do, it's going to be the beginning of the crash, because every single time in the past when the Fed has pivoted on interest rates, big crashes followed. So here we have the banking crisis in the works, and I've been talking about this for months now, not weeks, months, and it's getting absolutely worse. And another chart that you see here, these are economic numbers that are being ignored, that new orders are dropping. And you can see that the last 3 times that we dropped to this level, what happened? We had major recessions, right? And even market crashes. Here's the crash of 2020. The writing was on the wall long before that pandemic was being announced. The markets were already suffering outside of what we know of as the Great Pandemic, right? And here we are, again, right at that threshold. If you keep going on looking at the data, again, it's going to make you defensive. It may not knock you out of the market on the long side, but it's going to definitely make you feel a little little bit more cautious with your money. Now, my question is, will history repeat? Well, when you look at what's happened with mortgage rates as it compares to the percentage of income by most Americans, you can see how this is going up. And the last time it got up to these levels, we saw crashes right after that. Here was the big financial crash of 2008, and we're surpassed that here now, right? So that will affect home sales eventually. It will affect buying power. People are fearing that they're going to lose their home because they can't make the mortgage payment. They're going to cut back on some of their spending. Netflix, maybe they'll cut back on some of their internet services, perhaps. I don't know. Whatever people are going to cut back, they cut back if it's not a big priority. And so that eventually turns the economy into a recession if we're not already there. And then we go through that cycle, that ebb and flow of economic cycles, which we absolutely need. You can't have things going up and creating all these bubbles forever. Now, I talked about this, I believe it was late last month, or towards the end of last month. And this is corporate bankruptcies filing month by month. And you can see that this is now at a high that we have not seen in a long while. And so as the bankruptcies creep higher and higher, that again affects employment numbers. It affects the PPI, it'll affect the CPI, it'll affect all kinds of things. And you notice that with these bankruptcies, there are certain industries that are taking the hit more than others, particularly the consumer discretionary sector. And then that's closely followed by healthcare, believe it or not. So when you see stocks that are in these sectors, again, as part of your risk management plan, you might want to scrub your account and do a little bit of analysis on the fundamental side outside of the charts to find out, where your risk lies in these industries. Now, remember, let's talk about the CPI. They're celebrating that, but look at the PPI. This is not a downtrend, folks. This is accelerating. This is what the producer price index is showing. And the producers, as their costs go up and their prices go up, what are they going to do? They're just going to pass that on to the end line consumer. It's a pass-through. So you don't hear anyone talking about the negative side of this. They want you to focus on all the positive side. And that's where the real danger is. So when we look at, let's take a look at the SPXEW. This is the equal weight. We see that this is a wide divergence. It's right at a key resistance level. You could see that on the monthly charts, it looks even more severe when I go back and take a look at this. But I want to go back and look at the Qs, because if I look at the Qs on the monthly, I'm going to show you something that's very interesting. Our members know that I'm a big fan of the Fibonacci retracements and even using Fibonacci extensions. I'm going to show you how the Fibonacci extension calculator works in a situation like this. What you do is you go in, and different brokers have them located at different places on their charts. I'm starting at the 2020 lows, and I'm just going to draw a line from the March 2020 lows to the highs right here in December of 2021. Now I'm going to drop it and drag it. So this is a drop and drag tool. I'm giving you a little bit of some insight here, and I'll label this highlights of the Fibonacci extensions so that you could reference this in the future. Then you drag it back to the lows here, and it gives you the projection in target prices for the next leg higher. Now, look what we have here. My green dotted line that I drew on Wednesday is almost exactly at that Fibonacci extension, which is the target. Now, if you're, again, following me with A to B, B to C as it pivots lower, and C projecting into a target D, which is usually higher, we're at point D on a Fibonacci extension that's already at 100%. Can the markets go a little bit higher? Sure, they can. But this all up here, if you're using Fibonacci formulas, all of that on top is the danger zone for anyone who's a buy and hold investors. I get very, very excited about what we're doing here in Sticky Trades. And next week, I'm doing a guest appearance at the Wealth 365 Online Summit. This is where different speakers come in. They rotate in. I'll be speaking at 10 a.m. on Tuesday. And you could register right here, just putting your first name. You don't need last name, just first name, email, send you the notification, phone number. Again, no pressure. It's optional, right? We don't put pressure on anybody. We're not the hard sell guys. We want you to learn. We're excited about what we're doing. And from there, you'll be comfortable in the market knowing that you have all the ammunition and tools that you need to go forward. Thank you so much for liking and following and subscribing. One other thing is, if you are on YouTube, you can go into our membership on YouTube and you'll get special videos. The trades that I mentioned earlier with CCJ and others are brought up to our members on YouTube as well. So that could be a good stepping stone for you to warm up in a very inexpensive way to get involved with us. You try the 2-week trial out first for free. You can move on to YouTube. You can graduate to other levels in the company and the offerings that we have. And I will stick right by your side. Thank you so much, folks. Have a good weekend. So long.